Welcome back to Dreamlit Equity Research. Today's deep dive is on MercadoLibre, NASDAQ, MELI. This one comes in two acts. Act 1 is the core thesis. MercadoLibre isn't just an e-commerce company. It's Latin America's most powerful digital ecosystem. The region's answer to Amazon, PayPal, and FedEx rolled into one, operating across 18 countries with more than 750 million potential consumers. Act 2, which we'll get to in a few slides, is a direct head-to-head against Amazon, because that comparison sits at the heart of the entire bull case. The thesis rests on three pillars. First, e-commerce dominance. MercadoLibre is the fastest-growing large-scale marketplace on the planet, with GMV accelerating to $65 billion in fiscal 2025, up 26% year-over-year, and order volumes up 36%. Second, the Fintech flywheel. Mercado Pago processed $277 billion of total payment volume in 2025 and has become a standalone neobank challenger in Brazil and Mexico, cross-selling credit to 78 million monthly active users. Third, the infrastructure moat. The Mercado Envios logistics network and its fulfillment centers form a defensive barrier that now enables same-day delivery in major Latin American cities. Over the next 24 sections, we'll cover the company's history, its business model, the total addressable market, the full financials, the growth engines, a dedicated Amazon comparison, the competitive landscape, the risks, the core investment beliefs, price targets, valuation, and what to watch going forward. This is a research note, not financial advice. Do your own diligence. Let's begin. Quick disclaimer, because it matters. This is educational and entertainment content, not financial, investment, legal, or tax advice. I'm not a licensed financial advisor, and I'm not registered with the SEC or SEBI. Everything here reflects my own opinions, which can and do change as new data comes in. Investing carries real risk, including loss of principal. Perform your own research and consult a qualified professional before making any investment decisions. All third-party content is used under fair use for commentary, criticism, and analysis. With that said, let's get into it. Here's the snapshot as of July 2026. MercadoLibre's market cap sits around $91.3 billion. Trailing 12-month revenue is $31.8 billion, up 45.8% year-over-year, the fastest pace in 4 years. The most recent quarter alone brought in $8.85 billion, up 49%. Net income over the trailing year is $1.92 billion, actually down 6.8%. And that gap between soaring revenue and shrinking profit is the first clue that something's being deliberately traded off. Gross margin is healthy and stable at 44.5%, slightly better than a year ago. The stock trades around $1,801, well off its 52-week high of $2,548.50 and above its low of $1,495, with a beta of 1.34, meaningfully more volatile than the broader market. So here's the central strategic question this whole report is built around. Is today's margin compression the cost of building an unassailable moat, or is it the first sign that the credit book is growing faster than it can be safely underwritten? Strong top-line growth, a battered stock price, and a profit line moving the wrong way. That tension is what today's video is about. Before we walk the fundamentals in order, let's set up the frame this entire report hangs on. MercadoLibre versus Amazon. Here's the sharpest way to say it. Amazon is losing the logistics war in the world's most volatile markets. Amazon's playbook is the one that built an empire in the US. Raw capital, centralized nodes, global scale. It's a great model where the infrastructure underneath it is already reliable. It's a much harder model in Brazil, Mexico, and Argentina, where roads, ports, and postal systems can't be counted on. MercadoLibre made a different bet. Instead of layering a marketplace on top of infrastructure it doesn't control, it built the infrastructure itself. 50-plus owned fulfillment facilities, a purpose-built cross-dock in Mexico processing over 500,000 packages a day, warehouse robots in Brazil cutting processing time by 20%. That's not marketing spend. That's a hardware moat, and it's already showing up in the numbers. 76% of MELI's fast shipments now arrive within 48 hours, and shipping costs in Brazil are down 17% year over year, even as volume is up 39%. On the trucks and the sorting hubs, and density becomes a flywheel. More volume drives the cost curve down, and the savings fund the next round of build-out. That's the lens for the next couple of slides, before we rewind to the beginning of the company's story. MercadoLibre is outbuilding everyone in the region, and the numbers back it up. The company now owns more than 50 fulfillment facilities across Latin America, self-fulfills 55% of total shipments as of the first quarter of 2026, and delivers 76% of its fast shipments within 48 hours. Same, and next-day shipments are up 39% year-over-year, now totaling 199 million packages. This is a company building the physical network, not just marketing on top of somebody else's. In Mexico, the new XEM3 cross-dock hub cost $140 million, spans 80,000 square meters, and is built to process 550,000 packages a day, scaling toward roughly 1 million with automation. In Brazil, 2026 alone is bringing 14 new fulfillment centers and about 10,000 new hires, with logistics spin up roughly 50% year-over-year, growing the network to 42 centers. And at the Cajamar facility in Brazil, more than 300 shells-to-person robots are cutting processing time by 20% and saving 15% of floor space. This is a hardware moat in the literal sense: steel, concrete, and robotics, not just software. Putting it side by side, the scorecard is stark. On regional entry, MercadoLibre has been native to the region since 1999, versus Amazon entering Mexico in 2015 and Brazil in 2017. On fulfillment footprint, MercadoLibre has 50-plus facilities and is growing fast, while Amazon runs fewer, more centralized nodes. On core strategy, MercadoLibre leans on localized hardware, cross-docks, air fleet, robotics, while Amazon runs its global, capital-intensive playbook largely unmodified for the region. On fintech integration, Mercado Pago has 83 million monthly active users, versus Amazon Pay's comparatively limited regional footprint. And on the most recent quarter's growth, MercadoLibre posted roughly 49% year-over-year revenue growth, well ahead of Amazon's slower Latin America-specific pace. None of this means Amazon isn't a threat. We'll get to why it still is later. But on the ground, in the region, MercadoLibre is currently winning the infrastructure build-out. Now let's rewind to the beginning. The story starts in 1999, when Marcos Galperin founded MercadoLibre out of Buenos Aires, Argentina, building an online marketplace for a region most of Silicon Valley had written off. In 2001, eBay took an equity stake, an early credibility signal. By 2007, MercadoLibre became the first Latin American technology company to list on the NASDAQ. Through the 2010s, the company launched what would become its two defining platform services, Mercado Pago for payments and Mercado Envios for logistics. Both originally built just to support the marketplace, both now businesses in their own right. In 2019, MercadoLibre pushed into cross-border e-commerce, sourcing inventory from China. Then, in 2025, after 26 years running the company, Galperin stepped back into the role of executive chairman, and this past January, company veteran Ariel Sarfstin took over as CEO in a planned succession, right as Brazil's free shipping threshold was cut, reigniting growth. Today, the credit portfolio is nearing $15 billion. MercadoLibre has more than 100 million annual buyers, and the company just posted a record 49% growth quarter. What that history built: roughly 40% GMV share in Brazil and leading positions in Argentina and Mexico, 27-plus consecutive quarters of 30%, plus revenue growth, deep local integration across tax, logistics, and payments in 18 countries, a first-party retail layer stacked on top of the original third-party marketplace, and a Mercado Envios network with more than 10,000 drop-off and pickup points, advantages a new entrant simply cannot buy their way into quickly. MercadoLibre runs on two engines that feed each other. Commerce made up 55% of last quarter's revenue. The third-party marketplace, plus a growing first-party retail business, the Mercado Envios logistics network, and Mercado Ads, an increasingly AI-driven advertising layer. Commerce GMV hit $19 billion last quarter, up 42%, and commerce revenue itself grew 47.4%. Fintech made up the other 45%. The Mercado Pago digital wallet, Mercado Crédito for consumer and merchant loans, and Mercado Fondo, an asset management product whose assets under management grew 77% year-over-year. Fintech revenue grew 51.1%, and total payment volume hit $87.2 billion, up 50%. The newest growth pillar is the credit card. 2.7 million cards issued in a single quarter. Card transaction volume up 90% year-over-year. Card users up 68%. And management is rolling the exact playbook that worked in Brazil, in Mexico, and Argentina, framing it internally as the path to becoming Latin America's largest digital bank. The credit portfolio itself sits at $14.6 billion, up 87% year-over-year, while the 15 to 90-day delinquency ratio has stayed stable at 8%. Geographically, Brazil is still the largest market with roughly 40% e-commerce share and 39% currency-neutral revenue growth. Mexico is number 2, also growing 39% and competing head-to-head with Amazon. Argentina, the home market, grew 65% amid high inflation, and the smaller other countries bucket, think Chile and Colombia, is actually growing fastest of all at 59%. Zoom out, and the size of the opportunity is still enormous. Latin American e-commerce was a $151 billion market in 2023 and is projected to reach $232 billion by 2028 to 54% growth from here. E-commerce still accounts for only around 15% of retail sales in the region, while below developed markets and somewhere between a quarter and half of the population, depending on the country, remains unbanked or underbanked. That's the real long-term case. Even without adding a single new user, there's a long runway just from existing customers shifting more of their spending online and into formal financial products. Layer the addressable markets on top of each other, and the picture widens further. E-commerce GMV alone is roughly a $90 billion opportunity by 2026 estimates. Digital payments volume around $300 billion, consumer credit around $35 billion, logistics services around $15 billion, and advertising around $8 billion. Today, MercadoLibre holds roughly 35 to 40% share in Brazil against Amazon's 16% and Shopee's 10 to 15%. In Mexico, it holds around 30%, behind Amazon's 40%, backed by a further $3.4 billion of investment to close that gap. And in Fintech, its main rival is new holdings for the region's digital banking wallet share. Widening the lens further, Latin America has become one of the fastest-growing digital commerce and payments regions on Earth, even though it remains fragmented and underpenetrated. The e-commerce market has climbed from $151 billion in 2023 to an estimated $198 billion in 2025, on its way to roughly $218 billion in 2026 and $232 billion by 2028. That growth is drawing global attention. Shine and Temu have both named Latin America, and Brazil specifically, a strategic priority for 2026. But early signals suggest the localization playbook travels slowly outside Asia. Shine's planned production hub in Brazil has struggled to get off the ground, while MercadoLibre is deliberately raising, not harvesting, with roughly $11 billion of planned Brazil investment in 2026 alone. The structural tailwinds are broad-based. Rising smartphone and broadband penetration keep expanding the addressable online population. A young, underbanked population gives digital wallets and credit cards room to displace cash. Regional logistics infrastructure remains underbuilt, rewarding whoever owns the last mile. And Amazon's 2026 entry into 15-minute grocery delivery in Brazil is itself a signal that the category has become large enough to draw serious global capital. Breaking down where the revenue actually comes from, Brazil is about 55% of the total and grew 55% year-over-year in dollar terms last quarter. Its fastest ever item sold growth at 56% and unique buyers up 32%, the fastest pace in 5 years, largely thanks to that lower free shipping threshold, plus a Mercado Pago credit card that's now the #1 installment card in the country. Mexico is about 22% of revenue and grew even faster, 62% in dollar terms, with GMV up 48% and acquiring volume up 46% on a currency-neutral basis, a genuine re-acceleration backed by deepening last-mile logistics investment. Argentina is roughly 18% of revenue, growing 23% in dollar terms, but a much stronger 65%, plus on a currency-neutral basis, as macro stabilization takes hold and a credit card launched in August 2024 continues ramping, even as peso depreciation headwinds on dollar reporting begin to ease. Three different growth stories, but all three pointing the same direction. Now the numbers that matter most. Revenue went from $10.5 billion in 2022 to $14.5 billion in 2023, $20.8 billion in 2024, and $28.9 billion in 2025. Trailing 12-month revenue now sits at $31.8 billion. Growth rates across those years: 49.2%, 38.1%, 43.2%, 39.1%, and 45.8% on a trailing basis, re-accelerating, not slowing down, which is unusual at this scale. Gross margin has stayed remarkably stable, moving between 43.9% and 45.1% across the last 4 years. Operating margin is where the story gets more complicated. It improved from 9.5% in 2022 to a peak of 12.7% in 2024, then fell back to 11.1% in 2025, and quarterly, it's dropped even further, from 12.9% in the first quarter of 2025 down to just 6.9% in the first quarter of 2026, reflecting this year's heavy reinvestment. Net income grew from $480 million in 2022 to just over $1.9 billion in both 2024 and 2025, but on a trailing basis, it's actually ticked down slightly to $1.92 billion, even as revenue keeps climbing. Return on invested capital swung from 18.2% in 2022 up to 31.5% in 2024, before pulling back to 22.9% in 2025 and 16.7% on a trailing basis. In short, the growth story is intact, but profitability metrics are all pointing the same direction. Down, for now, because of a deliberate investment cycle we'll dig into next. So where's all that reinvestment actually going? 6 engines at very different stages. First, the credit card, 2.7 million issued in a single quarter, card volume up 90%, and the Brazil playbook now rolling into Mexico and Argentina. This is genuinely scaling fast. Second, the Brazil free shipping threshold cut, lowering the free shipping minimum to about 19 reais reignited items sold growth to 56% year over year, more than double the pre-cut pace, while unit shipping costs actually fell 17%, proven and expanding. Third, Mercado Ads, a high-margin advertising layer increasingly powered by large language models for better targeting, still scaling. Fourth, Mercado Fondo, the asset management arm, growing assets under management 77% year over year, deepening the fintech relationship beyond just payments and credit, genuinely growing. Fifth, cross-border sourcing and first-party retail, being used to defend against Shine and Temu on price and assortment, still investing. And sixth, AI and LLM deployment across search, advertising, and credit underwriting in Brazil, Mexico, and Argentina, still genuinely early stage. Put together, this is a company investing simultaneously across logistics, credit, and advertising. Expensive right now, but each engine individually shows real traction. Let's go deeper on the fintech arm, because it's become the more contested part of the thesis. Mercado Pago now has 83 million monthly active users, up 29% year over year, processing $87.2 billion in payment volume last quarter, up 50%. The credit portfolio is $14.6 billion, up 87%, with 2.7 million new cards issued in the quarter alone. The closest comparable is New Holdings, which has a larger standalone deposit base, but far less commerce integration. MercadoLibre's edge is that it already has the shopping data to underwrite credit decisions. The competitive wildcard is a 2025 partnership between Amazon and New Holdings, giving Brazilian Amazon shoppers financing options, a direct shot at Mercado Pago's credit card wedge. Traditional Latin American banks like Itaú, Bradesco, Santander, and BBVA still carry more trust and bigger balance sheets, but are far slower to onboard digitally and less woven into daily commerce. Here's why this matters. Every customer who converts from a payments user into a credit card holder becomes dramatically more engaged, deepening switching costs across the whole ecosystem. But credit and card revenue carry fundamentally different risk economics than simple payments. Higher yield, but also higher provisioning and funding cost sensitivity. And the number to actually watch, NIMAL, the net interest margin after losses, fell to 17.8% this past quarter from 22.7% a year earlier, as the newer, higher-yielding but riskier credit card mix grows faster than the seasoned, lower-risk consumer loan book. A deliberate trade-off management is making for long-term scale. Let's connect the operating engine directly to the revenue line. In the first quarter of 2026, GMV came in at $19 billion, up 42% year-over-year, while total payment volume hit $87.2 billion, up 50%. In Brazil specifically, items sold growth hit 56% year-over-year, versus roughly 25% before the shipping threshold cut, while unit shipping cost fell 17% in local currency. On credit, the portfolio has nearly doubled in a year, $7.8 billion in the first quarter of 2025, up to $11 billion by the third quarter, and $14.6 billion by the first quarter of 2026. On quality, the 15 to 90-day delinquency ratio sits at a stable 8%, while the 90-plus day ratio has actually improved to 17.6%, down from a 2022 peak near 30%. NIMAL, the net interest margin after losses, is 17.8%, down from 22.7% a year ago as the card mix rises. Provisions for doubtful accounts jumped 106% year-over-year to $1.24 billion, which management frames as front-loaded reserve building on fast-growing new cohorts, not a sign of deteriorating quality. And management specifically calls out Argentina's book as resilient despite macro volatility there. On leadership, this is a rare founder-to-insider transition, completed cleanly in January 2026 after 26 continuous years under one CEO. Marcos Galperin, who founded the company in 1999, is now executive chairman, focused on strategy and long-term AI investment. Ariel Sarfsten, a company veteran since 2017 who previously ran commerce and then Mercado Envios, became CEO on January 1st in a succession that had been planned well in advance. A meaningfully lower-risk transition than an outside hire or a sudden departure. Martin de los Santos, previously SVP of Mercado Crédito, is CFO, overseeing capital allocation through this heavy investment period. Osvaldo Jimenez leads the Fintech business end-to-end, payments, credit cards, and asset management across all markets. Daniel Rabinovich, the former CTO, now runs technology and operations, including the AI rollout across search and advertising. And Agustin Costa runs Mercado Envios, arguably the single most important operational lever behind this year's Brazil growth reacceleration. On the competitive picture, the sharpest framing is this. Amazon is losing the logistics war in the world's most volatile markets, betting on raw capital, while MercadoLibre is building proprietary hardware moats that route around crumbling regional infrastructure. Looking at the broader field, MercadoLibre carries about $31.8 billion in trailing revenue and a roughly $91.3 billion market cap, holding the number one position in Brazil and Argentina and number two in Mexico, with its moat being the only regional player combining commerce, logistics, and fintech in one stack. Amazon, at $700 billion plus in global revenue and roughly a $2.7 trillion market cap, is number two in Brazil and number one in Mexico by share, backed by global scale and its prime ecosystem. See Limited's Shopee, at $18 billion plus in global revenue and around a $78 billion market cap, is a fast-growing but still distant number three in Brazil, powered by a low-cost, gamified marketplace and Garena's gaming cash flow. New holdings at $14 billion plus in revenue and roughly a $60 billion market cap is fintech only with no marketplace, but is the largest digital bank in Latin America by customer count. And PDD's Temu at $55 billion plus in revenue and around a $180 billion market cap has already built more than 105 million monthly active users in Latin America, pushing an ultra-low price, manufacturer direct model. Head-to-head with Amazon specifically, MercadoLibre has been native to the region since 1999, versus Amazon entering Mexico in 2015 and Brazil in 2017. MercadoLibre runs a localized hardware playbook of cross-docks, air freight, and robotics, versus Amazon's more centralized, capital-intensive global model. Even so, Amazon is probably the bigger long-term threat, given its Mexico share lead, its new 15-minute grocery delivery push in Brazil, and that new holdings partnership aimed squarely at Mercado Pago's credit card. Shine and Temu are a slower-moving risk given their early stumbles localizing in Brazil, and New Holdings remains a formidable fintech-only rival for the same underbanked customer. Now the risks, and there are real ones worth sitting with. Most critical, margin compression. Operating margin fell to just 6.9% last quarter, down from 12.9% a year earlier, as management deliberately spends on free shipping, credit cards, and logistics. If operating leverage doesn't show up by 2027, the narrative shifts from strategic investment to structural cost problem, and the stock already fell 13% on this exact concern after the last earnings report. Also critical, currency exposure. Roughly 77% of revenue comes from Brazil, Mexico, and Argentina, all volatile against the dollar. Currency-neutral growth of 46% last quarter actually ran below the 49% reported in dollars, which is favorable right now. But Brazilian real weakness in 2024 shows how quickly they can flip, and all three markets carry real political risk. High on the list, credit quality. The $14.3 billion portfolio is growing 90% year over year, and while the 15 to 90-day delinquency ratio at 8% looks manageable, rising concentration in Brazilian credit cards creates systemic risk if the macro backdrop turns. NIMAL has already compressed nearly 5 percentage points year over year, and any deterioration in regional unemployment or interest rates could force a spike in provisions. Also high, intensifying competition, with Amazon investing heavily in Brazilian logistics and Shopee having entered, retreated, and potentially poised to return. The free shipping arms race compresses margins, but is necessary to defend share above 50%, and competition in Mexico from Amazon is intensifying too. And finally, valuation itself is a risk. At roughly 45 times forward earnings, any earnings miss or guidance cut could trigger an outsized derating. Think of how Novo Nordisk fell 50% from its peak on a single guidance miss, and MELI has already fallen more than 35% from its own 2025 highs on exactly these margin concerns. On the more moderate side, Brazil's central bank has already raised capital requirements for payment institutions once, and further regulation of Mercado Pago's credit, deposits, and insurance products remains a live possibility, alongside general regulatory unpredictability in Argentina. Three things need to hold together all at once for the bull case to work. First, today's margin compression is reinvestment, not erosion. If true, the Brazil free shipping cut is the proof point. Items sold growth doubled to 56%, and shipping costs fell 17%, and margins should normalize upward as logistics density and credit card cohorts mature, the same pattern seen in prior investment cycles. If false, if Amazon, Shopee, and Shine force MercadoLibre to keep discounting indefinitely just to hold share, this compression becomes permanent rather than a phase. Second, the credit book scales safely into a real digital bank. If true, stable near-term delinquencies at 8% and improving long-term delinquencies at 17.6%, down from a nearly 30% 2022 peak, suggest underwriting discipline is holding even as the book nearly doubles. and a mature credit card business could eventually rival new holdings' own fintech valuation. If false, a genuine macro downturn in Brazil or Argentina, a scenario the newest, fastest-growing cohorts simply haven't been tested against, could expose underwriting gaps that are invisible in a benign credit cycle, hitting both provisions and funding costs at once. Third, regional dominance compounds faster than rivals can catch up. If true, 27-plus consecutive quarters of 30%, plus growth and deep 18-country integration are advantages competitors can't buy with capital alone. If false, Amazon's new holdings partnership, its grocery push, and sustained Asian platform price pressure could erode share faster than MercadoLibre's reinvestment cycle pays off, especially among the most price-sensitive customers. With the stock around $1,801 and the next earnings report due August 5th, here's how the scenarios break down. In the bear case, an Argentine or Brazilian FX shock, credit card delinquencies deteriorating faster than provisioned, or the Amazon new holdings partnership eroding fintech share faster than expected. The stock could fall to $900 to $1,200, down 11% to 22% from here, with a multiple compressing from around 45 times toward 20 to 25 times. In the base case, growth moderating toward the mid-30s%, margins stabilizing as this year's investments mature, credit quality holding near current levels, and steady execution under new CEO Ariel Sarfsten maintaining investor confidence. A reasonable 12-month target is $2,000 to $2,300, roughly 11% to 28% upside. And in the bull case, where the Brazil shipping strategy repeats successfully in Mexico and Argentina, the credit card scales into a genuine regional digital bank, and operating margin re-expands past 13%. $2,500 to $2,800 is plausible, 39% to 55% upside. For context, the 20 analysts covering the stock lean firmly toward buy, with an average target near $2,215, implying about 23% upside, though that consensus spans from $1,750 at UBS to $2,800 at the high end, with Wedbush at $2,400 and Benchmark at $2,380, which tells you this is genuinely contested, not settled. On valuation, at roughly 44 to 48 times trailing earnings, with an EV to EBITDA around 24.9 times and a PEG ratio near 1.4. MercadoLibre trades at a real premium to Amazon's roughly 34 times earnings on 14.2% revenue growth, and well above deep value peers like PDD Holdings at just 9.5 times. It sits above C Limited around 32 times, but still well below richly valued Kuong at nearly 179 times. New Holdings, the pure fintech comparable, doesn't carry a comparable earnings multiple given its different business model, but remains the benchmark for what a mature Latin American digital bank could be worth. MercadoLibre's premium reflects a rare combination: 30 to 45% top-line growth, clear regional dominance as the only commerce plus logistics plus fintech company in the region, and a fintech arm scaling toward genuine digital bank status. A PEG ratio near 1.4 suggests the multiple is roughly in line with growth expectations, not obviously stretched on its own, but the stock's already 29% drawdown from its 52-week high shows exactly how fast that can compress if growth decelerates, a credit surprise emerges, or currencies move against the company. This is a name priced for continued execution, not for a stumble. If you're tracking this stock, a handful of things matter more than the rest. On earnings, watch whether revenue growth holds near 45%, whether operating margin recovers from that 6.9% trough, how gross margin holds versus the 43 to 45% recent range, how the commerce versus fintech revenue mix shifts, and how management talks about the pace of continued reinvestment. On credit, track the 15 to 90-day and 90-plus day delinquency trends across all three main markets, whether NIMAL keeps falling or stabilizes, how fast the credit card scales in Mexico and Argentina relative to the loan book, and Mercado Fondo's AUM growth alongside adoption of the MELI dollar stablecoin. On commerce and logistics, watch whether Brazil's item growth holds up after the free shipping cut, whether unit shipping costs keep falling, how Mexico's share battle with Amazon is trending, the mixed shift from first-party retail and cross-border sourcing, and Mercado ads revenue growth and take rates. And on the macro side, keep an eye on Argentine peso, Brazilian real, and Mexican peso, Amazon's grocery delivery and new holdings rollout, how Shine, Temu, and Shopee's localization efforts are actually progressing, and how the valuation multiple sits versus its own history and versus peers. The single biggest near-term catalyst is the August earnings report. A margin recovery from that 6.9% trough would be a genuine re-rating catalyst, while continued compression or a credit surprise would be the opposite. So, the whole thing in a few sentences. MercadoLibre owns the #1 e-commerce and fintech ecosystem across Latin America. Over 100 million buyers, 83 million Mercado Pago users, and a credit portfolio nearing $15 billion. A self-reinforcing flywheel that management genuinely believes is still in the early stages of a decades-long transformation. Unlike Amazon, it built the entire stack. Marketplace, payments, logistics, credit, and advertising, specifically for a cash-heavy, underbanked, logistics-challenged region, a moat 26 years in the making. Unlike new holdings, it already has the shopping data to underwrite credit. Unlike Shopee, it's actually profitable, with local roots Shopee can't match. What we like, $28.9 billion in fiscal 2025 revenue, up 39%, re-accelerating to 49% in the first quarter of 2026. Mercado Fondo assets under management up 77% year-over-year. An advertising business growing several times the market rate. The Brazil free shipping strategy driving the fastest buyer growth in 5 years. And management explicitly investing behind a long-term opportunity. What worries us? Operating margin compressed to 6.9% in the first quarter and needs to recover in the second half to validate the thesis. A $14 billion plus credit book growing 87 to 90% a year introduces real balance sheet risk. Brazilian real and Mexican peso exposure creates dollar reporting headwinds. Competition from Amazon and Shopee is intensifying in Brazil and Mexico, and a roughly 45 times multiple leaves very little room for a miss. At around $1,801, the stock sits between a bear case near $900 to $1,200 and a base case near $2,000 to $2,300. Meaningful upside if the reinvestment thesis plays out. Real downside if the credit cycle turns out worse than currently provisioned for. Let's close it out with 5 conviction points. 1. MercadoLibre is the dominant e-commerce and logistics platform across 18 Latin American countries, and that's not something a competitor can replicate with capital alone. 2. Its fintech arm is scaling into what management genuinely calls Latin America's largest digital bank. 3. 45.8% trailing revenue growth is the fastest pace in 4 years, even with today's margin pressure. 4. The credit portfolio is nearing $15 billion and growing 87% a year, with delinquencies stable so far, though so far is doing real work in that sense. And 5. At roughly 44 to 48 times earnings, real conviction here requires genuine tolerance for currency swings and reinvestment-driven margin volatility over the next few quarters. This is a name built on a real, hard-to-copy moat, going through a real, uncomfortable investment cycle. An August earnings report is likely to tell us a lot about which story wins out. If you're considering this stock, you need your own view on whether Brazil's credit book holds up and whether margins actually recover. Without one, you don't have a complete thesis. Do your own research, and thanks for spending the time with Dreamlit Equity Research. See you in the next one.